Ramesh Iyer, the Vice Chairman and Managing Director at Mahindra Mahindra Financial Services, joins us now. Mr. Iyer, that's the first question. Despite strong disbursals over the last few quarters, your write-offs continue to remain quite elevated. Why is that?
I don't know what's the correlation you're trying to draw, but the disbursements have been good, collections have been good. Write-off is an outcome of our NPAs that we settle with the customer, either take back the vehicle and settle, or offer a settlement to the customer, and therefore the balance gets written off. So it is from the past NPAs which have been fully provided for, we take a call to write off. So it will have a contra from the provision coming down and moving towards write off. Whereas the disbursals are a direct relation of the sentiments of the market, how we see the market progressing from where it is, what's the demand for vehicle, tractors, pre-owned vehicle, and all of that. And we've been beneficiary of that as we see the sentiments is very, very positive in rural.
Okay, I think the question arises as to, why the asset quality perhaps continues to deteriorate, right? On a quarter-on-quarter basis as well, you're sitting on, 8% gross NPAs compared to about 7.6% earlier. So just trying to understand whether, despite an overall growth, are you facing some pressure as far as asset quality is concerned?
So not at all, right? I mean, this we have talked about it several times in the past. Rural, the first half is always very different from the second half. So when you see a March ending at 7.77, and that's kind of remained almost at the same level as we speak, we expect that the next 2 quarters should only show much better improvement to this because the cash flows in rural substantially improve in the second half. The harvest money starts to come, the tourism at its best, the people movement goes up. So all of this money starts to come, and this is not for this quarter or what I'm talking, it's historically been that way. And therefore, we see definitely the benefit of that in the second quarter. And you look at the collection efficiencies have remained at 96% even in August, in spite of, many places, monsoons, not full activity levels. So this is typically of the first 2 quarters. Also important to see the stage 2 coming down, which means the forward flow is not happening. Put this all together and you will kind of, read the conclusion that the asset quality is actually improving month on month, and we would see this substantially change in the next 2 quarters as well.
Okay, Mr. Iyer, good morning. What's the guidance for credit costs for Q2 and Q3?
So we've always said that we expect as we move forward to close it around 6.5 as the gross NPA levels, and we are carrying a very high coverage ratio, close to about 58%, and that would mean that our net NPAs would be sub 3%.
Okay, net NPA will be sub 3%. A guidance on return on equity, Mr. Iyer, when can it touch 15%?
Actually, our capital levels are very high. If you look at our capital adequacy, we're at 24-25% kind of a number, and we've just started growth in our disbursement and asset book. And you look at our 3-year horizon, we have said that it will go to 12%, then to go to 15% in the next 2 years.
You lend to a lot of sectors, tractors, cars, utility vehicles, CVs, and there are diverse trends that we are seeing across the board, right? I mean, cars are picking up in a big way. Tractors were slow up until the last couple of months. Now, finally, there's some growth that's come back. Can you tell us what is the situation on the ground? Where do you see the pockets that still need to recover, and where is the maximum traction now?
I think you're right. Tractors did go slow in the first 2 months, and then we started picking up again, which is direct indication possibly of the contracting segment now buying tractors, and that would actually accelerate the growth there. As far as cars are concerned, availability continues to be some kind of an issue, and we do see once the vehicles are going to be more available, the festival season should end up extremely well. The pre-owned vehicle segment is very buoyant, and since the new vehicle non-availability, the exchange is not happening so much, and therefore even they are facing the supply side issue. As the supply on the vehicle, second-hand vehicle or the pre-owned vehicle starts becoming available, I think even that market would show even better growth. So I'm not able to see any segment which is going through any pressure. Even commercial vehicles have picked up. Neither are we seeing this pressure in any geography. And which is why we continue to say that the next couple of years should see this growth momentum being maintained in the rural market.
Fair enough. My question on credit cost also was a bit related to the fact that you'll be changing to the NPA norms, new NPA norms from 1st October. So how do you see that in context of that and the asset quality?
Yeah, so I don't think we see any major pressure. As I said, we are carrying a 68% coverage, and that's only a reporting norm, IRAC norm. So far as the accounting is concerned, will continue to be under Ind AS. and we may not be required to make any additional provision the way we see our collections and NPA corrections happening.
Right. Mr. Iyer, hi, good morning. We've been speaking with companies in, say, for example, the consumer durable, you do consumer durable financing, etc. as well. And, the feedback was, for example, we spoke with Godrej Appliances just last week. They said sales in rural areas are down at the lower end of the segment, but that's primarily in rural areas, is down 20 to 25% compared to same period last year. Premium is doing extremely well. Are you seeing some of that too?
We are a very insignificant player at this stage in consumer durables. We just about started. We don't even do 2-3 crores, and we are yet not gone into rural for consumer durables. So we are also just in 4 or 5 the states and districts, and I don't think our numbers will really guide the market sentiment. What we see in rural market, at least for the segment that we are in, the cash flows are holding up both in terms of people able to bring margin money to buy new vehicle and in our own collection. So I'm not seeing the similar pressure that you just expressed from a consumer durable side, but that's not the pressure we see on the vehicle front.
Okay. Fair enough. That's interesting. But could this be a signal of any for sort of future stress, or you think it's unlikely?
See, clearly, if somebody is able to bring 25% margin money, which means the cash flows are holding up. And where is this cash flow coming from? If you look at people movement, tourism, schools have started, contracting segment is doing well. So these were the cash flows which were hurt, around the COVID time. And we talked about it when we had a very high pressure first quarter last year. And then we said that these are the segments which are going through pressure. And as they kind of start to improve, we'll see improvement there. And today we see improvement in all of this segment and with no exception to geography. And which is why I'm not able to kind of, believe that there is a pressure out there. People are earning well and therefore they are repaying as well.
I just had one more follow-up on the trend that you're noticing right now, because within the commercial vehicle space, what we saw in the month of August is that the growth rate has slowed down quite a bit. It's now a single-digit growth that, a lot of these players are looking at, whether it's Tata Motors, M&M, about 6-8% growth. Of course, the base effect is also off, but just wanted to understand that has there been any slowdown in terms of movement of commercial vehicles compared to what it was? There was pent-up demand about 6 months ago, but now what is the, the average that we're looking at?
I think the way one has to look at it, I think the less than 5 truck owners are still not coming back to buy. And therefore, it's not adding up to growth. The fleet operators bought enough, and therefore the growth was double digit. And now that they have added sufficient capacity, they are probably not adding too many. Until such time, we don't see first-time buyer, single truck owner, less than 5 truck owner come back. You would continue to see this growth remaining in the single digit. And once they start coming in, and they would normally come in only when the market completely opens up and they're able to price for their cost completely. You should also understand currently the fuel price is high, whereas the freight rates have not gone up as much. And therefore, someone at that level of, less than 5 truck owner to now invest may probably wait and then come back. And that's causing little pressure, I guess, in the overall volume growth.
All right. Mr. Iyer, we'll leave it there today. Thanks a lot for joining us. Good talking to you.